All right, welcome back to TalkTickers. We're here to do what we do best, dig into the latest earnings calls. Today, we're taking a close look at Group One Automotive and their Q2 2025 results.
So Group One came out with a really strong quarter. They beat estimates on both the top and bottom line, and the stock shot up in the pre-market. But, and this is a big but, the rest of the trading day told a completely different story.
And this chart right here, this is the heart of the puzzle we're going to unpack. You can see it clear as day. A massive, almost 16% pop pre-market, and then, poof, it all just evaporated by the close. So what on earth did the market see that completely killed that initial buzz? Let's get into it.
Okay, first up, the beat, the pop, and that fade. Let's start with the good stuff, the headline numbers that got everyone so excited in the first place.
Look at these numbers. The company just delivered a solid beat across the board. Adjusted EPS, over 10% above what Wall Street was expecting. Revenue ticked up nicely, but check out that gross profit, a massive 22% jump year over year. On paper, this thing looked like an absolute home run.
So the big question is, where did all that strength come from? Well, it turns out the U.S. engine was just roaring. Seriously, the headline numbers were basically carried by the company's U.S. operations firing on all cylinders.
And you don't have to take my word for it. The CEO himself called the U.S. performance excellent in the second quarter. And you know what? The data completely backs him up. This was not just some fluffy corporate speak.
Let's start with the parts and service division. Gross profit there soared by over 27%. And you got to understand, this isn't just some side hustle for them. This is a key counter-cyclical profit engine. It's what protects their earnings when, those new car margins eventually come back down to earth. So this is huge. And here's the kicker. This wasn't just growth from buying up new dealerships. No, same-store growth was up a solid 14%. That proves there's real organic strength in the businesses they already own. That's a super healthy sign. And let's not forget about F&I. Finance and insurance. Performance there was rock solid. They added an extra $90 of super high margin profit to every single car they sold. That's a really critical piece of the U.S. profit machine.
So you look at the whole picture. New car sales, used car volumes, that awesome customer pay service revenue. The U.S. segment was just knocking it out of the park. It was strong. The execution was sharp. This is the story that lit a fire under the stock and drove that initial 15% rally.
But now we have to talk about the other side of the coin. Let's hop across the pond to the UK, because this is where the picture starts to get a lot more complicated. And honestly, this is probably what explains the market's big pullback.
Wow. Okay, this slide tells you almost everything you need to know. It's a tale of two markets. Look at SG&A as a percentage of gross profit. That's basically how much of your profit gets eaten up by overhead. In the US, it's a lean 64%. But in the UK, that number balloons to over 84%. That is a massive red flag, signaling a serious cost problem.
And management was pretty upfront about the challenges they're facing over there. You've got BEV mandates pushing sales into lower margin fleets. You've got the government piling on wage and insurance costs. That was about $4 million in Q2 alone. And on top of all that, the whole UK economy is just kind of sluggish.
So what are they doing about it? Well, they're taking some pretty drastic action. To get those costs under control, the company has cut about 800 people from its UK business. We're not talking about just trimming the fat here. This is a major workforce reduction. It's part of a very serious restructuring plan. All right, so you've got this mixed bag, a great US business and a struggling UK one. How is management steering the ship? Well, it all comes down to their capital allocation playbook, which is actually very clear and disciplined.
They're basically playing both offense and defense. Step 1. Buy more of what's working. They added 3 U.S. dealerships that are going to bring in around $330 million a year. Step 2, get rid of what's not. They sold off assets that were underperforming. And step 3, and this is a big one for investors, they're buying back their own stock aggressively. We're talking $167 million worth so far this year. That's a classic shareholder-friendly playbook.
Okay, so let's put it all together. It's time for the next call. We're going to weigh the bull case against the bear case and make our call on where we think this stock is headed.
So here it is, the bull versus the bear case, laid out plain and simple. In the bull corner, you've got that fantastic U.S. operation, a booming parts and service business, and a really disciplined capital plan. But in the bear corner, you've got serious margin pressure in the UK, high overhead, and just a tough macro environment over there. This right here, This is the core tension driving the stock.
So what's our outlook? For the next quarter, we expect more of the same, really. The strong U.S. performance is probably going to get partially canceled out by that UK restructuring drag. The single most important number to watch is going to be that SG&A leverage. As for the stock price, look, the market has already priced in these UK problems. The stock is probably going to be stuck in a range until the company can show some real, tangible proof that the UK turnaround is actually working.
So, our official rating is market perform. Here's why. You've got this fantastic execution in their main market, the US, but you've also got a massive project ahead of them in the UK. The upside is definitely there if they can pull off that UK turnaround, but so are the risks. It's a classic balancing act, and for now, we think the stock will perform in line with the market.
And that wraps up our analysis. As always, remember, this is not financial advice.